Good morning, Richard Calhoun, Creekside Realty, here to discuss Silicon Valley real estate market the past week, week number 26. I do have three new slides starting at about slide number 6. You may want to stick around. I think they're going to be very interesting. We're starting off with a sale price list price distribution for each week. Each line on here is a different week. The dotted lines are the oldest weeks, then the dashed lines, and the solid lines are the most recent 8 weeks. The trend earlier this year as we were going up, which is an improving marketplace, and the line was red. Finally, it occurred to me that we've been marching down now since March 26, and it was time for me to turn the line blue. Not that we're in a cold marketplace, but we're moving in that direction. I think what I will eventually do is try to gradient this line, and it's going to be very weird looking because basically from somewhere right about where we are now up would be a red line. From where we are now to just about the axis would be a white line indicating a neutral marketplace, and a cold marketplace would only be this area below the horizontal line of 100%. And the reason is buyers are very hesitant to make low offers, and they wait for sellers to reduce their price. A small reduction below 100% of your asking price becomes fairly significant as far as the market conditions. But anyway, the purple is the most recent week, and you can still see that 55% of the sellers are getting more than their asking price. Only something like 30% of the sellers are getting below their asking price currently in the last week for closings. So there is a lag time of about 5 weeks. And the 5-week lag time is simply the time to close an escrow. Here is the same data for just the last 12 weeks, same concept, dotted lines are the oldest, then the dashed lines, and then the solid lines. You can see the trend's been down this whole time because March 26th, which is the all-time best week we ever had, is just off by about 3 weeks. Now what we're looking at is the blue line is total available inventory. And so now you can see we're above the yellow line. So we have more than 100% of the inventory you'd expect to have for this time of the year. The gray line is the number of new listings coming on the marketplace, is more volatile because it's impacted by holidays and things of that nature. And then the red line is the number of offers that were accepted. And that's really the key that drives the real estate market for the most part. It's sort of interesting that the number of new sellers coming on the marketplace every week is fairly constant for that time of the year, regardless of what happens. Yes, there is fluctuation, but not nearly as much as the buyers fluctuate. And you can see that earlier this year, we were having about 120% of the 5-year median, which is 2015 through 2019, that you'd expect to have. Then very abruptly, we went from 120% down to 80%. And we've been bouncing around sort of 80%. And it's a lot more unstable. Yes, there's been spikes and movements up here, but they're a couple percentage points. Here you're going from something like 82% up to 95%, from 95% down to 75%, from 75% up to 95%, back down to 75%, 75%, and now we're back up to probably about 97%. So it's just all over the place. I wish I understood what it was. A little bit of it is the holiday timing, but the buyers seem to be very finicky, going from almost normal volume of inventory to dramatically below. I don't sense the economy. I don't sense the world, a place changing that much. Yes, we're paying $6, $7 a gallon for gas and $10 for flour, but that's been a gradual thing. So I'm a little perplexed on why the movement is so much sawtooth. And you can see there's fluctuation going into a holiday. You'd absolutely expect that, but you ignore that and you're pretty flat. And yes, we're going into July the 4th, but June is pretty holiday free. Yes, we have Father's Day, but Father's Day is pretty minor and is there every year. If anyone's got any explanation for why this has been fluctuating so much, I'd appreciate it. Now we're looking at the ratio of those two things, and I call that days, months sold inventory, and that's the real key. And basically, anytime you're below 40, that's considered by me to be a red hot seller's marketplace, between 40 and 80 to be a balanced marketplace, and above 80 to be a buyer's marketplace. Silicon Valley historically spends very little time in a balanced marketplace, which is where you'd actually expect it to spend its time, but it's usually just transitioning between one marketplace and the other. The faint blue line is my warning bell, which is 5 of change in DUI for every week, 5 days increase in this case, because that would be a worsening marketplace for every week that elapses. So 5 out of 7 days is the point at which it gets a warning. Normally we're increasing fairly good at this time of the year. So the fact that we were approaching this is something to be concerned with, but not that I'm going to be sounding my alarming bells. This data point actually looks like it's a bad data point when you really look at it, and then the data is well behaved. That actually is a real data point. It's accurate. It was caused by the buyers going away. That's one of the weeks where we dropped from 95% down to 75% of the volume of transactions. And when you're only looking at 1 week, that dramatically impacts the DUI because the rate of sales dropped. But anyway, overall, long term, which is what you're looking at, it's not going up that much steeper than it normally does it this year. Yes, it's steeper. Yes, it's approaching that 5 days, but I think you also have to somehow adjust for that it's normally increasing. It's still a concern of mine, and I don't know where it's going. Now, this becomes pretty interesting. This is simply the number of offers that were accepted in Santa Clara County, San Mateo County, condos and townhouses, which I call macro data. And you can see at the beginning of the part of this year, we were basically in second place. We were second place to 2021, which was outrageously on fire because of the pent-up demand from the shelter-in-place in COVID of 2020. So the fact that we were in second place really meant we were in the best year we were really having, in my opinion. But then dramatically, look at this. You went from second place to seventh place to first place, outdoing 2021, to fifth place to seventh place. But now it's noteworthy, basically since the middle of April, we've been at basically the worst out of the past 10 years. Now, if you observe, there's actually 13 years up here, but I only rated it based on the first 10. So it's rated on 2013 through 2022, but you can see that the numbers in 2020, 2010, 2011, 2012 were basically in line. So these 10th place finishes really could become 13th place finishes if anyone wanted to go through and do that. It's a dramatic shift. It happened basically overnight, and it's continuing. This is the first new graph, and it's simply looking at the number of offers accepted the past 5 weeks in the 4 counties. The 4 counties that I started following are San Mateo County, Santa Clara County, Alameda County, and Contra Costa County. And what I did is I went back all the way back to 1998, and I plotted all the data and looked at it. And finally, I came up with 10 years that were normal. And the 10 normal years are 2011 through 2019. They happen to be 10 good years. The red line is that median number. So this gives you an idea of what the market should be expecting when it's on fire and doing well. These are the bad years only. And the first bad year that jumps out is the gold line here, which is COVID. And you can see the rate of decline, and you can see it was fairly short-lived. It started basically when they announced it on March 17th of 2020, and then it turned around and it started improving on May 1st as soon as we could get out there and show properties again. The current line is the purple line, and you can see it's rolled over and it's coming down pretty significantly. And then the brown line is the mortgage meltdown, and it looks pretty flat and doesn't look that alarming, and you might almost be wondering why it's on here. And then you have 2001, which is on here, that looks pretty flat, and you might be wondering why it's on there. Well, that becomes obvious now. And all I did between these two slides is I looked at whether the year was above or below that 10-year median. I took whatever the red line data was for that given week, subtracted it from the actual data, and then plotted it here as a negative or a positive number. And since we're plotting bad years, it makes sense that the bulk of them are negative years. And now it becomes, I believe, a very telling graph. The purple line is the current year, and the faint blue line next to it is basically the slope of the line slipped up so you can see it. So I started here, went down here. So that's the slope and the duration of the line. Now I copied that exact slope and duration to the other bad years. Now, obviously COVID, I didn't need to do it because the duration is much shorter. The horizontal time is much shorter, and the vertical time, the negative impact, is much greater. So that's pretty clear, and I didn't think we needed any visual assistance. Now let's look at 2007. That's when interest rates, the liar loans disappeared, February of 2007, essentially. And again, now this is the same slope and same duration based on the current year. And you can see it's just slipped up a little bit there and slipped up a little bit there. So what it's saying is this year's data went a little bit longer already and is basically at the same magnitude. So you had the same negative impact at roughly the same time frame, and this would have to end now in order to not be worse than the mortgage meltdown of February of 2007. Another one I'm looking at is 2001. And there's two things that happened in 2001. One was the stock market. And I assumed that it's close enough here that you can do it. And yeah, it's a little bit steeper, but look how short the duration is. These parts are almost at the same starting point, but look how much further down the purple is already. So the negative impact already this year is greater than the March 2001 dot-com stock bubble burst. The other thing that happened in 2001 was 9/11. And here I brought over the line so you could see it. So the impact of 9/11 was much more dramatic. It was more sudden. The impact was more immediate and more severe. But the duration is already over. The duration is about half of what we've already been through. So to me, this is really interesting. So even though 2022, the current year, looks okay, when you look at it compared to where the market should be, it's almost alarming. Here is looking at the stock market. And I brought that in because I know someone's going to say, what happened about the stock market crash in 2008 in August? And basically, there is no impact on real estate. And I can't think of a better argument that the stock market has almost no impact, even here in Silicon Valley, where so much of the wealth has been made by people that own stock. Overall, it doesn't impact the real estate market. Yeah, there is some impact, but here is your August impact right here. And it's basically flat and improving. So the number of offers that were accepted wasn't impacted. Now, maybe the purchase price was impacted, but the volume was not impacted. Anyway, that's it for the new slides. Going back over to the old ones, we're now looking at the 5-week data for macro data, which is Santa Clara County, San Mateo County only, but single family homes and condos and townhouses. We're looking at two things. We're looking at the number of new listings that are coming on the marketplace. So you're up here, and the number of new listings is significantly higher than the number of offers that were accepted. And this is over the past 5 weeks. It's a more stable index. It tells you what's going on. And even though it's more stable, you can see the fluctuation here in the number of new listings. But you can see the normal pattern and everything like that. The real takeaway is when the blue line and the orange line or the brown line are close together, you have a red hot marketplace. When the blue line is above the orange brown line, then you have a cooler marketplace. And that's what we're having basically ever since somewhere, whatever that would be, which would be somewhere about March of 2022. And we were just so far into a buyer's marketplace that a little cooling off actually felt good for initially. And now it's starting to potentially be a concern. This is looking at DUI for the 5 weeks, Santa Clara County, San Mateo County, and you can see the climb. What's interesting is we have these little respites, and these respites happen the week when the volume comes back in. But keep in mind that even though we're at 50 and we're at a higher level than we've been pretty much at any time in this graph, there's a couple spikes up that are higher. 50 is still pretty much seller side of a balanced marketplace because 50 is to low, closer to 40 than 50 is to 80. Once you start getting to 80, 90, you start really transitioning into a buyer's marketplace. So you're in a balanced marketplace, but you're favoring the seller still to some degree. Although, again, I need to comment on the steepness of this rise. And yes, it goes up pretty steep. And part of that's because I'm trying to show a lot of years on here, but you can obviously tell that you have some spikes and we're clearly in a spike. The question becomes, how long is that spike going to last? Here's days on market of what's sold. I actually think this is a bad indicator. I put it there more to show that it's a bad indicator. The burnt orange down here is the median days, and you can see that it is going up, and we're now at 9 days. But 9 days versus 7 days really is not alarming sounding at all. And even the average days on market going from something like maybe 11 days up to maybe 14 days, being generous, it's probably closer to 13, isn't even that alarming. But you compare that to DUI going from something like 17 to 52, completely different world. And I believe this is more indicative of what the market is actually doing. And that's why media always talks about average and median days on the market. So I put it in there for completeness and to show why I don't use it. Sold price, almost everybody tracks just the median price. I like tracking the outer envelopes. I define that as the cheapest 10 percentile and the most expensive 10 percentile, 90 percentile to be more correct. So this is the most expensive homes, for the most part, right around 3.4 million. The cheapest home, and when I say homes, it's single family homes, condos, and townhouses in both counties. And the cheapest is somewhere around 850,000. Yes, you can find one that's cheaper, but there's only 10% of the total inventory that would be less than that. Now we're looking at the four counties: Santa Clara County, Alameda County, Contra Costa County, and San Mateo County. We're looking at 1 week and 5 week data. You can see that the number of new listings is down dramatically in all types of property this week, and that's because of the upcoming holiday. Many sellers will pause for an upcoming holiday, figuring that there's just not as much activity. We'll wait till the week after, or we'll race and go on a week earlier. The active number of new listings is down slightly, and that's because the new inventory coming on to replace what's sold is down. Then coming down to offers accepted, you can see offers accepted is actually up this past week over the week before, and it's up fairly significantly. The one exception is Contra Costa County condos and townhouses, and they've fluctuated for some reason more. Contra Costa is minus 12% all the way to Alameda County, which is up plus essentially 33%. So that's a swing of basically 50%. I guess the math would be closer to 44%, but a 44% swing in the level. Where you look at single family homes, San Mateo County was the weakest at, call it 10, and Alameda County was the strongest at 23. So that's a swing of 33. Now, maybe the holiday has bigger impact. But anyway, you can look at your individual areas. Offers accepted. Now, this becomes more stable because it's over a 5 week period of time, which is what the benchmark I usually use. But you can see there's some minuses and pluses. So there's still quite a bit of fluctuation. Then we get down to closings. And then we look at average price, the sale price to list price ratio, and what the median price is. Everybody can look at the area that's of interest for them. And with that, we're to the URLs. So I'll pause and see if there's any questions and then go over these URLs at the end. Not seeing any questions, I will proceed onward. Now what we're looking at is the total inventory. To the left of the purple line is 2022. To the right of the purple line is 2021. The yellow line is the inventory that you expect based on the 5-year median being 2015 through 2019. You can see we finally have more inventory than you'd expect to have, not dramatically more. We're at something like 2,300 and you'd expect to have 2,050. So 200, 250 more listings and you expect 10% more inventory than you expect. Not a huge influx of inventory, but still more than you'd expect. Number of new listings each week. This is the data that probably tracks the absolute best, which is sort of bizarre, which says that the incoming new sellers is almost constant when you seasonally adjust it. You can see we're coming way down. We're coming down because July the 4th. Now what we're looking at is the number of new offers accepted. And here you can start seeing last year, the data, the blue line was above the yellow line all year. It came down on top of it for the holidays, started off on top of it, and then again returned and was quite a bit above until it looks like week 15. From week 15 on, it's been below, but now the number of new offers shot way up from where you expect. So just the time you expect, consistency and down here, this number is up dramatically from where you'd expect it to be. Now, I suspect the reason for that is the calendar event. July the 4th is on Monday this year. So it didn't impact anybody this past week. It will impact us next week. So I expect this to be reversed for next week, and time will tell. This is looking for days of unsold inventory. Here is my 5 days per week warning. These are the 3 different counties. You can see that the gap got closer. So this is not going up at that rate. It's close, maybe 4 days per week, but not there. But you can see we've had a steady climb, essentially minus perturbations like this that are hard to see. Right through here, you can see there was a major perturbation. But long term, it's been basically an upward climb since about April the 9th. Now, this is my heat map. This is showing days of unsold inventory in the different areas. Anything between 42 and a half and 77 and a half is white in color. Below 42 and a half or above 77 and a half changes. Below 42 and a half becomes red, pink in color, and then above 77 and a half becomes blue in color. So we have significant amounts of blue now on the graph for the first time. There's a lot of white: South County, East San Jose, Campbell, Los Altos, Palo Alto, the coast, the Bay Cities, the San Mateo County North area. So the bulk of the area, I would actually say, is white. You have a few hot spots like Foster City, a fairly small micro market area. Redwood City remains absolutely on fire. 26 days of unsold inventory. It's hard to get faster than that, although we've been faster than that. We've had micro market areas hit some numbers like 6, 7, 8, and Cupertino, Sunnyvale at 28. So those are the two strong holdouts, and you can see them fairly red in color compared to the other areas. The slowest area is the expensive areas in San Mateo County, currently at 99 days of unsold inventory. And then the pale blue are up in Milpitas, the moderate affordable areas of Santa Clara County: Milpitas, North Valley, Berryessa, Santa Teresa, and then Saratoga, Los Gatos. So that's the concept. It allows you to see it visually. This allows you to go back over time. And now you can start seeing the blue come in. Last week we had one area of blue. Now we have 3 areas of blue. This pale pink here is pretty hard to see. It's much harder to see here. I think it's there. Pretty much white up here in the first couple areas. But if you go back in time, you can go back to May 28th. And in May 28th, the majority of the areas were red. So you can see that it's changed, and it's changed in 1, 2, 3, 4, 5 weeks. It's the length of time it takes to close escrow. So what we're going to be seeing now is what's happened to DUI going forward. So I would expect, at least for the next 5 weeks, for the amount of white and the amount of blue to increase and the amount of red to decrease. Now, it is possible that Cupertino, Sunnyvale, and Redwood City are going to be holdouts and are going to stay on fire because they're more desirable areas for whatever reason in the eyes of the current buyers. This is the frequency of overbidding, and look at the fairly significant drop here. I think this was only 2 weeks ago, because I think there's a data point there. So 2 weeks ago, 80% of the sellers were getting more than their asking price. Now they're down to 60%. And this is data for only 1 week. So this is the most recent closings, which is why it can drop that dramatically, which is why I favor the 5 week. 5 week gives you a better read on what the market's really doing. The 1 week reading sort of gives you a heads up: hey, something's happening. So this is saying something's happening for the last 2 weeks, which means something started happening about 7 weeks ago, which was week number 20. When I go back and look at the data, if I'm being analytical about it, I think I could probably argue that it started closer to week number 16. This is looking at the overbidding, and now we're back to the 5 week. So it's going to be a little confusing because I'm going to alternate so I made the label up here to keep myself honest. But even on the 5 week data, you can see all 3 counties rolled over. And at the 5 week area, Santa Clara County is getting around 72% of sellers are getting over at their asking price. And San Mateo is doing the best at something like 78%. This is the map of the overbidding. And now this is nice and pink and everything looks great. And people might say, well, why is there such a difference? This is going back in 5 weeks. So if you remember, I went back to that May 28th timeframe, going back 5 weeks. This is reflecting the color at that point. So I think what we're going to start doing is seeing some significant changes in this frequency of overbidding. And I also maintain frequency of overbidding doesn't change as rapidly as magnitude of overbidding. I maintain that a buyer is going to go from 116% of the seller's asking price to 108% of the seller's asking price pretty rapidly. And that's still going to be an overbid. So the frequency is sort of one of the last things to get changed. And here is the magnitude. We're same concept: 2022 on the left, 2021 on the right. And here you can start seeing in week 19, you started coming down fairly dramatically. And in week 19, if you take off 5 weeks for the typical escrow, that actually puts you back to week 14. So the change would have happened 1 week later than that in week 15. All right, so now we're looking at the overbidding magnitude for the 3 different counties: Santa Clara County in the red, San Mateo County in the brown, gray, Santa Clara County condos, townhouses in the orange. You can see Santa Clara County peaked out at about 117%, and now it's down to something like 106%. So it's dropped fairly significantly. You can see the drop started right about here, which is maybe right at the end of May, coming down. And again, this is 5 weeks lagging from the actual market conditions. And then San Mateo County, you can see peaked out at about 116%. It's down to 110. Condos and townhouses in Santa Clara County peaked at about 112% and is down to about 105.5%. So you can see that the magnitude of overbidding is in fact coming down significantly more rapidly than the frequency, which is exactly what I would have expected. Here's the overbidding plotted out, and you can see it is starting to get paler, and I would almost, it's not going to get blue because you have to get down to 99% to get blue, but we're going to start getting there in who knows when. And the market could change in the time and direction at any time. It could start going the other direction. So now we have the median sale price for the 3 major market areas: Santa Clara County in the red here, somewhere around 1.7 million, maybe 1.8 million. And then San Mateo County up at about 2.1 million, and condos and townhouses in Santa Clara County about 1 million. Now we're looking at the price distribution in single family homes only. A color is signed by the median number, median sale price, which is in the middle. The number to the left, the lower number, is the cheapest 10 percentile in that area, and the number to the right is the most expensive 10 percentile or the 90 percentile in the area. So you can see basically the southeast area of Santa Clara County is the more affordable areas, was the general rule. The expensive areas are sort of along the west side of Santa Clara County and right along the San Mateo County border, Santa Clara County, San Mateo County border. And then your peninsula is sort of the middle range along with Cupertino and Sunnyvale globally. But you can pick out whatever micro market area you're interested in, and you can see the different price range, like Campbell, Cambrian, Santa Clara, Willow Glen. The median is about 1.9 million. The cheapest is about 1.4, and the most expensive is about 2.6. This is looking at the appreciation for 5 weeks. I'm doing it over the entire 2020 calendar year, so it's a very stable base. You can see that all the peak pricing was back here right in basically the month of May. You can see we've rolled down quite a bit from that, but still having appreciation rates of 20% in the last 2 years is still pretty phenomenal. This is what the median price was in 2020. So you can take 100 in front of all these numbers and multiply it by that to find out the current median price in any given micro market area. Here's looking at the sum of the different micro market areas. You start off with Santa Clara County single family homes, drop down in San Mateo County, and then condos and townhouses in both. DUI, you can see, is much paler, much more blue. The frequency of overbidding is the reddest, which I said is going to be the last indicator to change. The magnitude is starting to go pale. And then the sale price distribution really has nothing to do with market conditions because it's always going to have the same color distribution roughly. It's just to give you an idea of where the cooler, cheaper prices are and where the more expensive prices are. And that doesn't change over time. This is looking at the key components. We're looking at inventory. We have 96.5% of the inventory we would expect to have, which I consider to be sort of be a balanced marketplace. In San Mateo County, 133%. That's more inventory than you'd expect to have, and that's why it's blue in color. That would tend to be a cooling effect of the marketplace. Santa Clara County condos is the same at 176%. We've talked many times about why I've crossed out the Bay counties, and it's just their condo market has changed so dramatically. I don't believe it's reflective of market conditions. DUI is sort of a relative number that doesn't need to be comparing it. So it's just this week and last week. Anything in the 40 to 80 range is a balanced marketplace. So that's why all the numbers are black. Everything's in what I would consider to be a balanced marketplace currently. Moving over to the frequency of overbidding, anytime you're getting more than about 50% of the sellers getting their asking price, I would consider that to be a strong seller's marketplace. The balanced marketplace is from 33 to half the sellers getting more than their asking price. So you go almost anywhere else in the country and say say, hey, half the sellers are getting more than their asking price, and you consider it a balanced marketplace, they'd look at you really cross-eyed. And on the magnitude of overbidding, anything from 99 to 101.5%, I consider to be balanced. Everything is still quite a bit above that. We're getting close down here in the Bay City condos at 102%, and not far off even in Santa Clara condos and even Santa Clara County single family homes at 106.5%. A couple more weeks, we may be approaching that 101%. Here's the appreciation over the 2020 year, and this is again based on 5 weeks, so it's pretty stable. This is actually pretty noteworthy in San Mateo County. They're up 21%. And if you think of that 21%, that's pretty good. They were up 24.5% in 2021. So they're actually, the median sold price for the county of single family homes is actually lower now by 3% than it was a year ago. And that's why this is blue. It's not that I consider 21% to be bad appreciation. That's fantastic for a 2-year period of time. That's 10% a year. It's bad in the fact that it was higher a year ago. Yes, it was way higher even this year, which I might do it, but there's overshoot every year. Comparing the peak to the current numbers, probably not the best thing in the world to do. I probably should look at sort of the consistent number and compare it, but that takes more data processing time, and I'm already at my limit, I think. But that's why this is flagged. It's flagged because 21.5% is less than the appreciation in 2021. That's the only one that's there. Everybody else is in between the two. Redwood City or Bay City condo areas, everything basically from the crest line down to the Bay, San Mateo County, south of like Coleman area there, because that's North San Mateo County. It's now down 3.3%, less than it was in 2020. So the appreciation based on the median for price of condos in that area is down actually for the 2-year period of time, which is clearly a cool marketplace. Again, I believe a lot of that has to do with the type of homes that were built in that area since 2015. There was an awful lot of high density condos built, high-rise condos, which are less expensive than condos and townhouses that have more land. That brings down the property price without bringing down the property value for comparable properties. This is looking at almost apples and apples. I call it the June data. Most of the data was taken on July the 6th. In recent years, before that, I did a moving look at it, and you can see they're all basically the first week in July, going back 35 days. And back here, it was a bizarre calendar thing that I never liked. I counted 5 weekends and 4 weeks to get to 30 days. Now I'm doing 35 days all the time and doing a moving. So anyway, we're real close to apples and apples comparison. Also take into consideration that not much is going to happen on the 2nd, 3rd, or 4th. So the only time anything's going to happen is on Tuesday the 5th. Not much is going to happen because most buyers are going to resist funding a loan over the weekend when it's a holiday weekend. But anyway, you're looking at 21 days on the market. That's fairly reasonable. It's actually on the low side. 37 for average is on the low side, meaning price is up a little bit. And this is asking price, not sale price. Inventory is probably the most useful thing to pay attention to, 1165. You look back, in 2019, there was more properties available. And again, in 2016, 2015 was basically the same. 2014 had more. So you had more inventory fairly recently, basically in my base years, 2010 through 2019. All those were about where this is. We've just been in an exceptionally low years low inventory since we got past pandemic, i.e. the last 2 years. Coming down to DUI 51, which is a key indicator. Now that is basically one of the slowest numbers we have in what I consider to be my normal years. You start going back into 2009, 8, you have to pay more attention. But in 10 and 11, we had a slower marketplace, but we were in an improving marketplace. Now we're roughly the same order of magnitude, and we may be in a declining marketplace. Can't predict the future. We're definitely not super hot on fire like we had been. Now, probably the most telling thing is offers accepted per day. We're only at 22 and a half. I don't think you're going to find a single year with less offers accepted. So right now, the buyers are in control. The buyers went away and the buyers aren't buying. There've only been, I think that's 788 again, because that's just going to be 35 times the daily number. Again, that's the lowest. So that's the real flag, is the buyers aren't buying. There's not much for them to buy, but they're not buying what is there to buy. Then you get down to closings, you get the sale price, 106%. You can see that's good. It's no longer the record. Last year was better, but again, 106% is pretty impressive. It's one of the better years. 72% of the sellers getting more than their asking price is also right there, respectable with some of the top years. And the pricing is some of the highest. But at $1.8 million, yes, that's an awful lot for a medium priced home, but that did go north of 1.9 million. I'm thinking it was 1,935,000. 1,935,000. I should get that number in my mind. And then the number of closings is at the record low. These are not apples and apples comparisons. And even back in 2008, it wouldn't be an apples and apples comparison, because starting in 2011 backwards, I use calendar months, although I guess my closings down here, 35-day closings. Yeah. So to see the difference, if I did 35-day closing, I'm at 1191. So you have to compare this line down here to the 938. I'll go over these URLs real quickly. The green is what I call my root URL. My root URL is sort of the key that gets you to the past archives on YouTube. It gets you, if you add in 2022, it will get you to the live presentation Saturday morning at 9 a.m. If you add in the handout 2022 for the year, the month of 07, and the day of 02, you'll get the handout. That was posted about 10 minutes before the hour of 9. And then if you want to get any specific episode, you put in the year, the 4-digit year, the 2-digit month, and the 2-digit date code. So I try to make it easy to remember the codes. I actually remember them instead of having them linked. And with that, if anyone's got a question, go ahead and ask. Not seeing anyone unmuting themselves, I will end the meeting. Have a great week, everybody. Take care. See you next week. Bye now.